Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta, Executive Writer at CTMfile. Joining me today is Paul Galloway, Senior Advisor at Strategic Treasurer. Welcome back to the Open Treasury podcast, Paul.
Thanks, Push. I appreciate you having me back.
This week, we are focusing on 5 themes, namely interest rate hikes and the economy, ESG, Treasury technology, payments, and finally, mergers and acquisitions activity. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first theme for today is about interest rate hikes and economy. The Australian Central Bank, the Reserve Bank of Australia, is ready to make higher increases in interest rates than predicted if the country's inflation does not begin to ease, says the RBA's Governor Philip Lowe. His comments came as the RBA announced the 7th consecutive interest rate hike since May, which took rates to a 9-year high of 2.85%. In the US, the Federal Reserve is expected to increase their rates this week as a countermeasure against inflation. And in the Eurozone, the European Central Bank has announced a 0.75% interest rate hike, bringing the key deposit rate for the 19 countries sharing the euro to 1.5%, which is the highest rate for the region since 2009. Paul, my question to you is that while central banks around the world are hiking interest rates to combat inflation, will such hikes not increase the borrowing cost of corporates, limit their expansion and investment plans, and possibly result in escalating credit risks?
Yeah, Push, I think there's a couple things in that question to address. You sit here and you look at rates at 2 to 3%. For cost of capital. It's been a while since we've had rates in this range. And actually, the norm was to have rates much higher than this. So we've been in this arena before. I think it's a matter of we have to realize globally that we're no longer getting free money. Because we spent a long time where it's been free or near free because costs have been really, really low in terms of cash or acquisition to cash. Returns on cash have not been grand either. So it's been both sides of the coin. But with all that cash, it's allowed the world to expand. And so I think this is just showing that from a global perspective, our economies are interlinked. And the fact that we're seeing other central banks making these rate hikes, they're seeing inflation in their own countries. We're all sharing in the pain today. And so when we think about rates, where they are and where they're probably going to end up going in the next 6 to 12 months, we are going to see more rate hikes. The cost of capital is going to increase. The thing I think corporates are going to have to take into consideration is, given the current environment, can I position myself for future growth? Can I make acquisitions that will generate a return greater than my cost of capital? And so, yes, my cost of capital is increased, but it doesn't mean I can't acquire capital to go out and grow my business. They still can. It's going to cost more. It's just a matter of, can they generate the kind of returns that will be required to feed the investor appetite for the risk associated with the investments that they make? I think just based on normal capital markets, the way they behave, they will. Will there be more perceived risk in certain areas? I think there absolutely will be. Will there be some higher costs for some of these entities? Absolutely. I think we're going to see for certain industries and businesses, we're going to see spreads also widen along with these increase in rates. especially with the way inflation is. Real returns are just getting dinged. Corporates writ large, I think they'll continue to make investments to get the generated return required by investors. Different risk profiles, perhaps, for some organizations, and seeing 75 basis points in Europe, not surprising. And I look at these rates. When I started out early in my career, we had rates much higher than this, 2 to 3 times as high. And that was the area or the arena we were in at the time. And businesses didn't they didn't stop borrowing. They didn't stop making investments. I think we'll see that the right organizations will take advantage of opportunities out there that will help them grow and secure a return that's required by their shareholders.
Very valuable insight indeed. Our second story for today is about ESG and how more US corporates are linking executive compensation to ESG performance, with the share growing from 66% in 2020 to 73% in 2021, according to findings that have come from a new report by the Conference Board produced in collaboration with Semler Brossi and ESG data analytics firm S-Gage. The most significant increase was found in companies' use of diversity, equity, and inclusion goals, rising from 35% in 2020 to 51% in 2021. In addition, an increased focus on climate change saw the share of S&P 500 companies that tied carbon footprint and emissions reduction goals to executive pay almost doubled from 10% in 2020 to 19% in 2021. Paul, what, according to you, are the key takeaways in this compensation linked to ESG performance report, and how do you think this report will impact corporate treasury?
I think the thing that is interesting about this is, I don't see the data points on this for sure, but in terms of how much of their compensation is tied to ESG, I think that perhaps is more telling. These things are certainly important: environmental, social governance, diversity, equity, inclusion. These are important things. And some of these things have been around for a while, but they haven't been to the forefront like they are today. If executive compensation has a significant percentage allocated to these causes, to this arena, ESG, then I think it has, more impact, it has more influence. It makes a bigger difference in terms of what the executives at corporates are doing, right? When I started, I'm fairly early in my career, diversity, equity, and inclusion became something that companies were really starting to focus on. And the fact that it's increased so much from 2020 to 2021 just tells that companies are saying, hey, you know what? This really does make a difference, and it is important. It helps strengthen organizations to take these focuses and bring it to the forefront within the company culture, what they do, how they act, how they behave. Because certainly action makes a difference. You can say, oh, I'm supportive of this, but if you aren't acting to support it, then that's really not support. You have to have action tied to it. And so when it comes to anything tied to executive compensation, I always look at what's the makeup of their compensation? How much does this impact it? Does it really have enough influence on the executive behavior to make decisions that support ESG, DEI? If it does, that makes a difference. It makes a difference to the executive, to the organization, to our local communities, our broader communities, and perhaps on a more global basis if it gets far-reaching enough.
Those made for some very interesting insights. Paul, moving on to the third theme for today, which revolves around Treasury technology. The first story is about TreasuryPay, a real-time data and intelligence company, and UST, a US-based digital technology and transformation provider. They have or are in the process of collaborating to optimize treasury and trade functions while also responding to the growing demand for human-centric customer experiences and measurable results. Paul, in your opinion, how will the TreasuryPay and UST partnership benefit corporate treasury departments?
Well, Push, I think what is becoming more apparent in the treasury arena is that they want to be able to have information faster. And we've been running towards that, I think, for several years, just in the technology that's out there today and the technology that's being developed for the future. And so whether it's payments or data, reporting, it's all how quick can we get it? Of course, speed is one piece. So speed is good, but accuracy is also good. So it's a must. It has to be accurate. So you have to have speed, you have to have accuracy. And then I think the other thing is that the right source of truth, meaning that you can rely on the data. This partnership is pretty interesting to me because it's really the direction that Treasury, as a practice is heading. Everybody that's participating in the Treasury arena, whether it's, our firm or it's the corporates or the privates, the publics, whoever it is that we're talking to that's in the Treasury arena, their mindset is going towards this. Can I get the information in? Can I synthesize it? Is it accurate? Can I rely on it? Because I'm going to take this, I'm going to transport it to people inside my organization to help them make decisions. And it may be my own team as a treasurer, or it may be my executive team that is looking at the company today and where it's going to go in the future. And so this is an important step forward.
An important step forward. And, our second story in the Treasury technology section may also be another story, in your words, that may be helping the entire treasury management business move forward. This is about Kyriba, the cloud-based finance and IT solutions group, launching liquidity planning, described as a totally reimagined cash flow planning and forecasting solution. Liquidity planning unifies financial planning and analysis, working capital and treasury data across multiple scenarios, giving CFOs and treasurers data, insight, and actionability to accurately manage the cash life cycle and improve the accuracy of free cash flow projections. Given that it's tough to do liquidity forecasting efficiently and accurately in an uncertain economic environment fraught with multiple scenarios, do you think Kyriba's liquidity planning platform, the innovation that they claim, can enhance cash forecasting for corporate treasurers and CFOs?
It's my hope that it will. I can tell you what I'm hearing from our clients is that liquidity planning and forecasting is at the forefront. And so it's something that's becoming more and more important to treasurers, assistant treasurers, the people that are trying to make decisions around what's it look like today, what's it going to look like a week from now, 30 days from now. Do I have the right facilities in place? Do I have the right access to cash or capital available at hand in case I need it for something that's going on in the organization, either on the business unit level or by our, the executive team when they're making decisions around M&A or other activity that helps grow the business, product development, and so forth. A tool like this, it's important. It's extremely important. And so I think about kind of the whole vision. So you have cash forecasting. You have your FP&A team that does the longer term forecasting. You have a budget team that outlines what the corporate budget is for the year. You're taking these three, putting them together to get a view of what's going to be the demand on my cash at any given time over the next however many days it is. Let's just say 30 days. What's it look like for the next 30 days? Will I have, based on what I know today, will I have enough cash to cover and maintain a certain level or buffer? And so I think bringing these all together where you can get a vision of, okay, what do I have? Where can I get it from if there is a need? Because there's always those one-off things that, and this is what might be outside the planning piece here. It's those one-off things where somebody in the organization has not communicated to the Treasury team that, hey, we need $50 million for something this day, or $200 million, or whatever the amount is, but that has not made its way into the forecast itself. So just the normal activity that you know about and everybody's communicated to you at the point in time, understanding if you've got the liquidity in the right place, that's important. Then it's, I know where I can get it from, and do I have enough for those one-offs that are not planned? So treasurers are looking, okay, I've got this cash today available here. I've got these third-party partners that I can make short-term arrangements with to get cash if I need to inject cash into the system on a temporary basis. And you've got contingent facilities, you got backstops, you got your revolvers, you got your commercial paper programs, Federal Home Loan Bank, all these different levers that you can pull. As a treasurer, you're trying to make sure that you have all those lined up. So when you do your liquidity planning, you can understand, do I have enough to cover these things plus a buffer and things that are unexpected? So I think this is really a good step forward. We're hearing the demand for this from clients. So obviously it's hit Kyriba. They've heard it from their existing clients or prospective clients. The other providers that are out there, if they don't have something like this in place, they will shortly.
That's great. Moving forward to our next section, which is about payments. Let's discuss our first story, which pertains to MasterCard's aim to strengthen its strategies towards diversifying payment flows, as well as exploring new network opportunities such as open banking and cryptocurrency, while simultaneously competing for debit volume in the aftermath of the US Federal Reserve ruling on debit card transaction routing, as has been reported in certain sections of the media. Paul, how will MasterCard's strategy to diversify new payment channels and compete for debit card volumes affect the world of payments?
I think from MasterCard's perspective, if I'm them, making a diversification play really makes sense. They have a massive footprint as it is today. It's been in place for quite some time. And so if I'm MasterCard and the ever-changing world, especially on decentralized finance platforms, the DeFi that's being really focused on today with cryptocurrency, new ways to pay for things or acquire things using newer technology or new payment rails. There's new payment rails that are being built out there. You hear about in Asia, the development of payment rail to compete with SWIFT. Right. You've seen SWIFT making changes themselves. If you are in the crypto world, you'll hear them talk a lot about DeFi, blockchain, DTL. This gets a lot of attention. So I think this is MasterCard recognizing that payment rails are changing. I need to position myself to be ready for this so that I can participate in the direction it's going, because the reality is it is changing. And if MasterCard wants to continue to be relevant in the arena, I think they have to take this step forward. At least that's what I would do if I'm them. It doesn't mean that they still don't have a good business platform. It just means there's opportunity out there, and I think they recognize that there's opportunity out there. And so this really kind of makes sense.
Very interesting that you mentioned the two words relevant and opportunity, because our next story in the payment section is possibly connected to these important words, relevance and opportunity. This story is about the European Commission unveiling a draft law that would force banks to offer instant payments in euros at no extra cost. In contrast to existing card payments and direct deposits, which can take up to a few business days, the European Union intends to revitalize or modernize the payment system in order to enable faster transfer of funds from one account to another in seconds at any time of the day or night. Paul, will the European Commission mandate boost cross-border instant payments in the European Union, lower transaction costs, and thereby significantly improve cash flow for businesses?
It certainly makes sense to me to go that direction. There's a couple things in there. One, speed of payments definitely makes a difference. The other piece is adoption of this. So the question will be in my mind do you get enough adoption to pay for the system? Because you have to have volume to bring down the cost. That's just a fact. That's the way it works, right? Yeah. So over time, absolutely, I think costs will be lowered. I think organizations getting cash quicker, and you hear more and more talk about this. Hey, we can run payments 24/7. I think in my lifetime, that's definitely going to be something that we're going to see out there. It's kind of exciting in a way. You can kind of see the future. This is an old school movie, I have in my head, a Harrison Ford movie. It was very futuristic when it came out. And the way that they made payments in this movie was instantaneous. It was happening day and night. It just amazes me how movies, the thoughts of people who write these movies come up with these ideas. And in the future, we actually kind of bring these to fruition. And this idea or this concept of being able to do this. And by the way, I didn't name the movie offhand, but it was Blade Runner. I just found that really fascinating how they did these things. And thought, geez, why aren't we doing this today? But that was a long time ago they made that movie. And here we are decades later, and European Union's already heading that direction. And you hear more and more talk about that. What will be interesting is to see with increase in remote working, more flexibility and work lifestyle. If you've got pockets of where people are working different times throughout the day, maybe part of the day they're focused on day transactions and they do something else, and then in the evening they work some more. I just wonder how this changes work lifestyle down the road. But definitely will lower costs with increased volume. It's definitely better for organizations to get their cash sooner than later. Anybody that's a finance person understands time value of money. Getting my dollar today is worth more to me than getting it tomorrow. So I'll take it today, please.
Those are extremely valuable in terms of your analysis. And moving forward to the next section that merits discussion, which revolves around the slump in merger and acquisitions activity that is extended into the third quarter as rising borrowing costs, the ongoing Russia-Ukraine conflict, and volatile stock markets continue to dampen sentiment for deal making. Paul, given the global economic and geopolitical uncertainty, along with the rickety stock markets and rising financing costs, what would you, as an experienced treasury consultant, if you were to advise finance chiefs and corporate treasurers, what would you tell them in terms of adjusting their deal-making strategy? Would you tell them to avoid acquisitions entirely, adopt an wait-and-see approach before pursuing big-ticket acquisitions, focus on small to mid-sized deals, or expand overseas for acquisitions?
there's a couple things in this. One, from my standpoint, because I did corporate development for five years, so M&A activity I think is a very viable part for organizations. I know some people would argue that there isn't a good M&A transaction out there. Some very prominent investment folks have said that, but I do believe there is a place for M&A activity. When I think about how executives deploy capital within an organization, M&A is part of the pie. And so we've got return of capital. And so return on being existing platform, new products, mergers, acquisitions, other investments. Then return of being your common dividends, share buybacks, or other extraordinary dividends. So you have kind of this balance going on. And with that, on the return of capital profile, it's underlying cost of capital. So for some organizations in a raising rate environment, it may be prudent for them if they've been considering certain acquisitions to do it now versus later. So you may see some influx of organizations engaging in utilization of capital, raising capital for M&A transactions that can be accretive. I don't see it as something that M&A goes away. I think where the opportunities are is interesting that you brought up doing acquisitions outside their local country, right? So doing something outside, if I'm a U.S.-based company, just starting there, if I'm a U.S.-based company, M&A transactions outside the U.S. may be a place that I have an interest. There are some opportunities out there for organizations. If you're looking outside your country, your home headquarters, I think that could be a unique opportunity for organizations out there. And there are some organizations that are divesting of assets, foreign-based assets today, that I think could be opportunities for the right organizations out there. I would definitely look for activity outside U.S. and Canada M&A activity. I think we may see a little bit of a slowdown. There could be a little jump more near term, but over the next 6 to 12 months, I think there'll be a slowdown. I think this will be kind of a consistent pattern globally, but I think the M&A activity isn't going away. The opportunities are going to be more focused. They're going to be more strategic plays that, really make an organization take a step forward. Obviously, they're going to be focused on, can I generate the required return given my cost of capital structure? If I'm a CFO, CEO of a company, I'm taking inventory of my current business, understanding where I want to take it in the future given my strategy. I'm taking inventory of my existing cost of capital structure, the capital I have on the books for deployment, and then I'm making decisions around how I want to fund an M&A transaction. And quite frankly, if they have the ability to do it, the capacity, it may make sense for them to fund it all with debt. It would be instantly accretive in most cases.
Those are wise words, Paul, and I hope our target audience was listening to you and your views carefully. Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why.
I can't avoid talking about, in the U.S., biggest story that I heard was the recent story about the break-in in Nancy Pelosi's house. I thought, it was one of those things where I think people need to take an inventory of their thought process and what they're doing. Politics is obviously a really hot topic right now, given we have midterms coming up here in a week here in the U.S. It's good to have diverse thoughts and opinions, but when people are taking actions like that, we don't need more of that. I hope that people can take a step back and we can avoid these kinds of things happening in the future. Kind of saddens me when I hear headlines like that.
Thank you, Paul, for your insightful analysis and comments. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.